Hi, this is Dave from Market Trading Concepts for Saturday, May the 12th, closing out the week for Friday, May the 11th. Now I've broken this video up into different segments because it was getting quite long. I focused part one and part two on the stock indices, the stock indexes, and I am now going to take a look at the some of the currencies and some of the metals. I thought it might be a good idea to kind of break these up because the videos can get pretty long when I feel that, you know, first of all, I use this as my research going into the following week. So I like to spend some time looking at and recapping, you know, the major markets on the weekend. But I think there's some pretty important things setting up in the markets, so I'm spending even more time than usual. So let's take a look at the dollar index. Now, the dollar index is in from the weekly basis. It still is in this big zone here on the Darvis squeeze on the weekly chart. Okay, you can see in my radar screen it's saying that we're in a potential breakout situation, and I'm just going to expand the weekly chart, and it's a little bit messy, but what you can see happening is we're at some areas where we're kind of in the middle of this range, and we've broken through this intermediate wedge. So if you look at this, now I've got a couple of different lines drawn on here, but let's just pick a different color here. You've got this kind of wedge coming into play here, okay, and then we've broken through the top of that. Now, at this point in time, to me, what the markets look like they're saying is, look, we don't want the U.S. dollar lower. We want the euro higher, lower, but we don't really want it much lower. So to me, it looks like, it sounds kind of silly, but it looks like the markets are just trying to keep the euro and the dollar in a back and forth kind of dance where nobody's really winning. Okay, there's really no clear decisive action one way or the other. Now in the dollar index, you've got, you know, this situation where it's still in this weekly Darvis box, and it's looking like there's some strength coming in. But now let's take a look at the euro, and you can see a bit of a different picture that played out, where the euro has fired, okay, a weekly Darvis short. Now we've been talking about this 130 level that is pretty key. Okay, this key 130 level. I'm really going to try to just expand this. See if I can make this bigger. So we had an initial Darvis squeeze coming back. Let's see. This was this week. These are weekly bars now. So 1, 2, 3 weeks ago, going back 3 weeks, we had an initial Darvis squeeze short on the weekly chart. We've been talking about this key $1.30 level, right, where we've been in this range here on the weekly Darvis between 134.99, roughly 135, okay, 135, and we've been below, I mean, in between that and 130. Now, we had an initial probe of that level, and you can see it jumped, you know, almost 300 ticks from that level, which if people got on the short side on the first test of that, they just would have probably gotten blown out of that trade. Now what you can see happening is you can see this situation where now it looks like it wants to follow through, right? You've got this 1 bar break of the on the weekly chart of the $1.30 level, a close at $1.2924. So I think that, you know, it's looking like the euro wants to go lower. You've got a valid weekly signal here, but I'm a little bit cautious on this because although I believe that maybe we could grind lower into this $1.2644 level, the U.S. dollar is really, it just looks to me like they're just kind of dancing. They're just dancing back and forth, and neither one is the clear winner. Now, the euro is showing signs of weakness and saying, hey, it looks like I might be going lower at this point in time, so maybe it's kind of losing the breakdance fight. But, what I'd be looking at is being a cautious short on the euro below $1.30 with reasonable risk and reasonable stops. I probably wouldn't risk more than the top of this weekly bar here, and I'm not even sure where that's coming into play here. I'd have to zoom in and draw a line there. Let's actually just do that. I would be very cautious on this because I think these markets are really a little bit skittish. I mean, I think $1.30.69. If I was to take a short here on a swing basis on the euro, I think I'd look for a little bit of a retracement back into around the $1.30 level. But I don't think I'd be willing to risk at this point in time. I wouldn't be really willing to risk above $1.30.70. So let's say I would probably, if on a swing basis, have a stop around 10 ticks higher than that high of this weekly bar, because I think at this point in time, although it looks good, I think the risk reward for a trade like this looks really good, and I'd be willing to risk this because it is kind of confirming and following through. I don't think I'd be willing to risk more than that, but the potential upside on a trade like this, if you get stopped out, you've managed your risk, it's a losing trade, it's not the end of the world. The potential upside on this, though, is a move all the way down to like $1.2650 level. I'd probably get in front of that a little bit early, and I'd probably get out at like $1.2670 or something like that. You wouldn't want to be trying to get out of that when it's bouncing back up off this level. If it finds support down at this level, which seems to be a fairly major level. So to me, the euro looks like a decent short, somewhere around $1.30. Okay, now it's at $1.2924. So maybe a minor bounce up towards $1.30, or even a break of this level, with a stop of around $1.30. What did I say? 79 looks interesting. Now this is not specific trade advice. This is something that I would be looking at. This is for educational purposes. This is something that I would be looking at if I was going to initiate this trade from a swing trading basis. This is how I would approach the trade. This is how I would probably execute the trade, looking for a follow through of this Darvis squeeze to the downside on the weekly chart with very limited risk. I don't think I'd want to risk more than that. Okay. Now this could come right back up and ding you out and go lower, but that's the kind of risk you take when you're a cautious trader. You've got some signs here. You're below your zero line, but this is kind of rolled to the high side. But if you look at the price action, it took a long time to break this level, and it was a pretty decisive break. But it was only a 1 week break here. So will that hold? Don't know. Looks interesting though to the short side with that, with those parameters in place, in my opinion. Now then, if we look at the daily chart, it's looking even a little bit better because you had some of these key levels in play here, and you can see that you also had a Darvis squeeze short fire when it broke this Darvis box, which coincides with these kind of key levels as well, around $1.30 with a short target. You've got a short target of $1.20. What is that? $1.2819. So those are some intermediate targets there. $1.2819. So if you looked at this and said, okay, maybe I'll take some profit at $1.2819, and then tighten up your stop so that once it hits that target, you even trail it down so that you're in the profit on the second half of your trade or whatever. That would make sense as well from a trade management perspective. But you've got this Darvis squeeze coming into play on the daily chart, which is coinciding with the story on the weekly chart. You're below the zero line here and you've crossed over. That's boding well. You've got volume picking up a little bit here too, right? A little bit above the average there. And then you've got, the trending indicator. My trending indicator is also on the downside. So this actually looks like a pretty interesting trade. The question is, how much are you really willing to risk? I think I said $1.30.79 on the weekly chart is what I'd be willing to risk, with that being a tight position. And you can see your 21 EMA here is coming in at about $1.3103. So within 24 ticks, you've got, you could place even a stop above your 21 EMA there on the daily chart in order to limit your risk. So the question is, are you going to get a bounce to get short? If you got a little bit of a bounce to get short, would even be better. Back up towards the $1.30, maybe a retest, test the $1.30, and then say goodbye to that level and roll over. But all in all, from a risk-reward perspective, it looks like an interesting trade, and it makes a lot of sense at this point in time to me. So take that for what it's worth. Okay, let's take a look at the Aussie dollar. The Aussie dollar's a friggin' mess. I mean, I think I was saying that I liked it potentially on the long side again last week, or in one of the last videos, because it was looking like a Darvish squeeze reversal on the daily chart, right? So if you look at it on the daily chart, we weren't going any lower at the time, and we actually fired a Darvish squeeze reversal. You had a break of the trend line to the downside. You put in, okay, so you had a break of the trend line to the downside, so it broke up above it, and then you put in, here you had a low, and here you had a higher low. So that was looking good. And then you got a long signal here, okay? Then you got a Darvish squeeze long signal here. So this is a Darvish squeeze reversal that took place here. But what you can see is that, reversal signals don't always follow through. And that's exactly what you got here. Your trend was still to the downside. You were still below the zero line. So all it really did was come up and test this zero line in the MACD, and then it rolled over. And you can see it failed that breakout, that reversal, and then it just kind of continued lower. And then it actually fired a Darvish squeeze short signal, and with a target of 99.17. So it's at about 99.90 at this point in time. It looks like that's where it closed. These are kind of tough markets to trade. I mean, it looked like we were getting a reversal, and then it just kind of followed through to the downside. Let's take a look at the weekly chart and see what that's looking like. Now you can see here on the weekly chart. Let me just expand this out. On the weekly chart now, the picture has changed dramatically from that reversal to now it looks like, okay, here's your high. Now you have a lower high in place. Okay, and then it failed this Darvish box, and it's just looking, short side now. So, and it looks like it failed that, if I just draw a loose trend line in there, it looks like it failed, this uptrend line. So these are really tough markets to trade. And if you're not sure, I mean, there's nothing wrong with erring on the side of caution and just stepping aside or taking trades with with acceptable risk parameters. I mean, you should always do that anyways, and not be willing, not trade with what you're, more than what you're willing to lose. So at this point in time, I'm really cautious on the Australian dollar. Looks like it wants to go a little bit lower. You've got a lot of congestion in this area. At this point in time, I'd probably leave it alone, although it does look more negative than positive. Okay, let's take a look at the British pound. Now, the more I look at these markets, the more it seems to me like the world revolves around the US dollar versus everything else. If you look at what's going on in the world, it seems like the US dollar and bonds are driving everything, and the other, all the other currencies in the stock market are moving, opposite of those things, or at least the US dollar seems to be the driver for a lot of the moves that are taking place. Now, I liked the British pound. I liked the British pound long with a pullback to the 21 EMA, right? So if you look at that on the weekly chart, you had On the weekly chart, you can see on the British pound, you finally had a Darvis squeeze breakout to the high side here, right? And then on the daily chart, you can see the 21 EMA is here. We spent a lot of time above that, and what I was looking at was a pullback to the 21 EMA. Well, we did get this going back, I guess, to Monday. I believe that's Monday. But look at what happened. It pulled back to the 21 EMA, and it did work. I mean, you did get a bounce off of that level, but look at the bounce you got. The bounce was weak. I mean, that is a really weak bounce. That's not the kind of action you would expect from something like if you were day trading that, or if you were in a mini swing trading position where you were, let's say, in it for anywhere from 1 day to maximum, probably it looks like maximum 2 days. You could have potentially caught this move here. And I've taken trades like this before where I'm very cautious and I'll just buy this bounce. You know what I mean? I'll buy the test. I'll wait for like the 5 or the 15-minute chart to roll back to the high side. I'll get in, and when it comes back up, I'll cut the trade. And usually with a decent options trade, you can make 10 to 20% on that. But looking at this type of trade, it really didn't work out very well. I mean, you probably could have made this potentially if you caught it at the right pullback point and then sold it up here. But this isn't the kind of action you'd want to see on something that looks like it wants to move higher and then comes back down, tests the 21 EMA, and then it hardly bounces, and then it kind of, it fails and it closes below there. That's not the kind of action you want to see in a trending environment. And it looks to me more and more like we're in a phase where these kind of pullback to the 20 EMAs are just not working very well. I mean, they historically over time they work really well, but it seems to me, I've been noticing this more and more on different chart time frames, that we're in a period of time now where these kind of pullbacks where you expect them to do something, they're not really working out very well. Here's a case in point. You got an initial bounce, but it just kind of failed that. You would be expecting you'd be expecting a much better bounce than that. I mean, you wouldn't expect it, even if it didn't bounce better than that initially, you really wouldn't expect this. You wouldn't expect that situation. You would expect it to kind of be somewhere in here for a couple of days and maybe push a little bit higher. This is something that I wouldn't normally expect for a good continuation swing trade based on this kind of a setup. So at this point in time, I'd be really, really cautious about trading the British pound on the long side. The initial bounce was weak. You know what I mean? The initial bounce was weak, and I don't really trust the price action. It doesn't look very good. So at this point in time, the only currency that looks really good to me, and it doesn't even really look that great, but it looks like the path of least resistance on the euro is lower. Not sure if that will drag the other currencies down as well, but I've got some clear signals at least on the euro with limited risk. The other currencies don't look so great to me right now, at least not at this point in time. That can change any day. Okay, I just had my dog Pistachio jump up on the chair with me here, so I'm just teetering on the edge of the chair with a 13-pound dog taking up 80% of the room. So that said, let's move on to some of the other currencies. I'm not even really going to cover the other currencies. I just looked at the Canadian dollar. I've got nothing on it. Looks really sloppy. Japanese yen on the weekly chart, it's coming back up to this potential short area. I don't like it either. I don't like the price action. I don't like it for a short. If you reviewed last week's video, all my reasons are exactly the same. So with that in mind, I think it makes more sense to kind of jump forward. Let's take a look at the gold market, the gold futures. So the gold futures here, we've got on the daily chart. Let's just change this to red. On the daily chart, we have a fired signal for the Darvis squeeze, a recent short breakout 4 bars ago. So if we take a look then at the, let's look at the weekly chart. The weekly chart broke that Darvis box, and we seem to have support around 15 1545 in this area, but let's expand the daily chart where we have the actual signal and see what's going on here. So you can see this series of here you have a lower high, lower low, lower high, lower low, lower high. Here is where it looked like maybe the market wasn't going to go any lower, but then you came back up here and you did not put in a higher high, you actually put in a lower high, and now you're set, you fired a signal and you're set to put in a lower low. Okay, so the structure of this these lower highs and lower lows is still in place, and now you have a Darvis squeeze short at 1612, okay, with red Hakodashis, right? Your squeeze fired off. You've got an increase in volume here, which would denote that, it's picking up steam to the low side. You're below the zero line on the MACD, and you have you've got short side bias on the trend indicator. So if you look at this, you have a potential target. Let me just see here. You have a potential target here of 1544. Now, I like that level because, let's just jump back here to the weekly chart. I like that level here because I've identified this support area on the weekly chart, in here, okay, of 1545. So 1545, 1544, I mean, give or take a point. I think we could, I think it makes sense that we could easily get another, where did we close at? 1584. So it looks like we could easily test that level. I like the confluence between those two levels in the daily and the weekly chart. And if you look at strictly as the easy call is just to say, yeah, we'll probably retest those levels where we may find initial support. And if we break those levels, then we'll have to reevaluate that. That's really the line in the sand right there. But, we closed at 15, it looks like 1584. So another 40 points of downside in the gold looks like it's in the cards. Let's go back to the daily chart for a second. Just bear with me here. Yeah, so 1544. We did close at 1584. I just wanted to make sure of that. It looks like we closed there. So right at 1584. So yeah, another 40 points of downside looks to be in the cards for the gold, unless, barring any kind of crazy circumstances. That's where the path of least resistance looks, and it looks like we might, get that 40 points of downside. That looks good. Okay, let's take a look at silver. So we were both right and wrong on silver, which sounds a little bit goofy, right? But on silver, I think last week I said that it didn't look like silver wanted to go any lower. It was either last week or the week before, and I can't remember exactly because I don't really have time to go back and review the videos, but I have an idea of what I said. So if you look at this, I said initially what I said the other week was that if we follow through with these downside targets on silver, that it looks like we're going to hit around the $29 mark, okay? And I got that target from here when this Darvis squeeze fired here, but then it looked like right in this area when this Darvis squeeze fired here. Then what it looked like, though, is that we didn't really want to go any lower because the market, these are momentum setups, and you expect these momentum type of setups like the Darvis squeeze to unfold fairly quickly. So when it wasn't unfolding as quickly as I expected it to, I thought, okay, now maybe the upside surprise is we're going to have a reversal situation take place, and it's going to catch everybody flat-footed. Well, that didn't happen. My original outlook kind of came into play. My revised outlook, when it wasn't going any lower, did not happen, but my original outlook was, okay, if we follow through with these sell signals, and everything was negative. That picture didn't change. It just was taken for friggin' ever to play out, right? So so then what happened was when that didn't play out fairly quickly, it ended up playing out and firing another signal. So you got another short signal right in here that happened, let's see, that's Friday, 1, 2, 3, 4, 5 or 6 days ago. So between last Friday and last Monday, that just happened last week, you're looking at, another short signal firing, and it ultimately came down and tagged that 29 level. We were looking at the $29 level in silver. Okay, we're looking at $29 to the short side as an initial target from our original, from these original signals that fired back in here, and then they fired again and they followed through. So would we have gotten on the long side? No, we didn't have a signal to get on the long side. We thought that there might be an upside surprise. We were looking at potentially, the upside surprise, but we didn't actually get any signals. We didn't get any signals that there was going to be a reversal take place, and in fact, we had another short signal fire that at that point in time you could really only just go with it. Once it broke, it held this level. Once it broke this level again, this is a situation that you can only really go for it. It actually came down and hit this target of, it hit the target of 29, which was my original target, and then I think it went about 50 cents lower to around 28.50 or thereabouts. So silver right now is short side. It is well below this 50 to 60 618% retracement of the major move that took place way back here. And at this point in time, there's no reason to get on the long side of this market because all indications are short. So the only thing you can really do in this market is look at maybe finding an area to get short, maybe on a retracement. It's already hit these targets. So as far as I'm concerned, I'm not really looking in silver for any additional short side. In fact, to me, this looks like, this area is being accumulated. You see these tails on these daily bars. So I think it would make more sense to wait for some kind of retracement and then to see if it's going to roll over again or not. At this point in time, I'm really not interested in this market, but if I was going to take a position, I'd be looking at a retracement to get short. So that's kind of what I'd be looking at. Okay, let's take a look at the crude oil market. What a friggin' crazy market. I personally, I thought when we saw this long signal fire here, right, I thought we were going to go higher when we broke these highs. I thought we were set to go higher in the crude oil, and we did. But we found resistance just above $110 a barrel on the weekly chart. And if you look now on the weekly chart, which I'm just going to expand out, you have a Darvas squeeze that came into play, right? It was against the major trend, right? It's against the major trend, but it did fire here, okay, at about, we had a pretty major support level. I remember talking to some of the guys in the trading room, and I think we were, they asked me several weeks back, are you interested in shorting the crude? And I said no, because I think there's pretty strong support at about 188 a barrel. And that was going back somewhere in here, and we actually got a really nice bounce off of those levels. And then we came back up here, and we failed to retest the highs. And as you can see, this is going back a couple of weeks that we were talking about that. But then when it came back down through that support level, somewhere in there, and it's hard to see because it fired multiple times, but then you got a Darvas squeeze to the short side on the weekly chart, and it just collapsed through that level, and now you've got a target somewhere around $90 a barrel. Now you've got quite a bit of consolidation in these levels. You can see that these levels here that spend a lot of time here, I would expect this to probably get tested and to initially find support somewhere in this I don't know, I'm not drawing any specific lines in here because I just wanted to comment on the overall direction of the market, but $90 to $92 a barrel it looks like. In fact, let's just draw a line in here just so that we have it going forward. somewhere in where this target is, where that target's coming into play, you can see these areas coming into play as well. So that's about $90.80 a barrel. So I'm gonna leave that line on there. I may tweak it a little bit moving forward, just to kind of to look where most of the areas of contention were. But that looks to be a pretty important level, around $90 a barrel. Make it a little bit thicker. Now, that said, it is against this major trend, but it is totally losing momentum, and it wouldn't take much to push this indicator into a situation like that where it's below the zero line. So these are really volatile markets. You can see this minor trend line that was there got broken, and when it got broken, this was obviously an important support level, and it just, it had no real support below there, and it just kind of collapsed. So that was a pretty big move in crude oil. And if we look actually at the daily chart and expand the daily chart out, you can see also excuse me. You can see on the daily chart we see this long signal in here, and how quickly things changed when it actually totally reversed back into these support levels, and it fired a short signal right at $100.81. So that was really close to the 188 that I was talking about. So about 100. Let me just expand this a little bit so it's easier to read the numbers. I think it was about $181 a barrel, so $100.81 a barrel rather. And then you can see it hit its target really quickly. I mean, that was a one-day move, right? This is a daily chart, so that's a one-day move. So it moved the range of this box, this Darvas box, in one day. See, that's what I'm talking about when you get a momentum type setup. You don't necessarily expect to hit it in one day because it's hard to actually get on board, but not like silver that took several weeks to play out. This was on the exact extreme of that move, where it only took one friggin' day. Okay, it only took one day to play out. That is, that's extreme. So, but that's kind of what you expect with a momentum setup, that it's going to play out fairly quickly. The failure of this signal, I guess, was a signal in itself, and it just, that's where the MACD did give you an indication of that, because it was below its zero line. But I personally thought that crude oil was going to go higher, but then you can't fight these signals when it comes down and it fires a short signal. This is some pretty crazy action. You're initially finding support down here where you can see it's being accumulated, but if we don't hold these support levels, then I think the $90 to $92 a barrel prices may be in play. Okay, now would I get short here? Absolutely not. What I would what I would expect to have happen. Oh, I keep coughing, and I promise I'm not a smoker. But what I expect to have happen here is, I would expect to have maybe a bounce here and a retest, and to see if it's going to fail some of these levels and then roll back over towards a target of, let's say, $90 to $92. So that's kind of at this point in time what I'm expecting to happen. Whether it's going to do that or not, we don't know. This could, these could be the support levels here. But a break, let's say a retest of this, let's say it comes back up here and then it breaks this level here, then I would expect that to play out. So there's a couple different ways to trade this. You could say, okay, I'm going to short a retrace back up here with limited risk, or I'm going to wait for it to do that, come back down. Once it breaks this level at 96, I'm going to sell stop that. I'm going to get short. I'm going to get short below this intermediate support, and I'm going to look for, something with a suitable risk down to, these targets. So there's a couple different ways that you can approach the market. You can sell markets on weakness. You can buy markets on strength. That doesn't always work. Or you can, if you believe that we're in a reversion to the mean type market, you can wait for the retest, or the retrace rather, to, a key dynamic moving average, and then you can drill down to a lower time frame chart, look for some weakness, and then establish your risk there, where, let's say your 60-minute chart rolls over, you get on the short side, you place your stop above there, and you expect it to roll and break this level, or you can just, sell stop it if it breaks that level again once it does that kind of scenario. So there's a couple different entry techniques that you can use for markets depending on what kind of trader you are, but recognizing that it doesn't really make sense to trade against the the predominant path of resistance. So in my to my thinking, path of least resistance is to the short side in crude oil at this point in time until proven otherwise. Okay, let's take a look at natural gas. I'm going to look at the UNG. I don't have a better data feed than that. Than kind of using this stock as a proxy for what natural gas is doing. Now at this point in time, I don't like the short side of natural gas. I mean, we've been short for a long time. We mentioned in a video, I believe it was last week, the week before, that on some of our other chart analysis, which I haven't really shown here, we have a technical divergence on the daily chart in the natural gas, and you can see that you've been short side for a long time, and then when you came up, now you're above on the daily chart, you're above the 21 period exponential moving average on the daily chart. There came a point in time where I didn't really like natural gas to the short side anymore, for a number of reasons. One of them was that technical divergence that played out. And I'll actually, why don't I just take a quick look. I'll just pause the video, I'll take a quick look, and I'll show you what that divergence looked like on some of the other charts that I use to trade the markets. Okay, let's just take a look at it from a different kind of, I look at charts a number of different ways. I have different chart configurations for different things. This is kind of, this is the charting that is set up, when I watch Rob Hoffman's trading room. So when I'm watching Rob trade, I kind of look at these kind of charts. These are sort of his trademark setups where he has, the 20 period exponential moving average. He has his speed lines. He has these are, this is my own indicator here. He uses the stochastics in this way. We've got the RSI on there. And then this is my trending indicator here. So this is kind of a Rob Hoffman type of chart layout, and I do look at charts from this perspective, mostly for reversion to the mean type of stuff. But taking a look at this, like you can see from these lows here in the price, right, going down to these lows in here and these lows in here, you can see the predominant pressure in the UNG or in the natural gas has been down. It's been selling off for a long time. But then you can see in this trending indicator of mine, it doesn't show up very well in this trending indicator, and this is why I use different types of trending indicators. You can see at this point in time, right? It's not exact here, but let's say this low here. Okay, you can see that swing low and this swing low in the indicator, and then you can see these swing low points. You can see that as price has been moving down over a long period of time, this trending indicator has been steadily moving up, and it's been putting in, here's a low, here's a higher low, and here's another higher low, right? So it's been steadily putting in higher lows in the momentum of this indicator while the price action has been going lower. To me, this is a cautionary sign that the market is extremely, extremely, extremely overdone. It's extremely oversold. And although I'd be willing to potentially look at, a short side entry over here, you have to be very careful in these situations because, you had, for example, you had it pull off of this level. But, if you got in at the 21 exponential period moving average here, right? Let me just, I just wanted to highlight this technical divergence on the UNG just to highlight why I was very cautious on the short side, moving forward from a swing trading perspective, where I started not to really like the short side in it any longer. Okay, So just going to pause the video and flip over to the other charts. Okay, so let's take a look now. Let's take a look now at the weekly chart then of UNG, and you can see kind of where we're going with this. Now, the weekly chart, wow, that looks awful. Let me just expand this out. Okay, so the weekly chart here, if you look at this, you can see that we are now above, I mean, we are still sell side, but you can also see, you can see that divergence taking place on the weekly chart here too, where price action has been going lower, and you can see in the indicator's been moving higher over a period of time. So at some point in time, something's going to give. And you can see now that, now we don't know if this is actually going to be a trend changer in terms of, I mean, we're still in a massive downtrend, right? So you don't know at this point in time if, the actual trend, the actual long-term downtrend in natural gas is going to change. But what you do know is that it's time to be cautious on the short side. So you can see now on the weekly chart, you've closed above the 8 exponential moving average on the weekly chart. You've had 1, 2, 3 weeks of real strength in the market, and your next real resistance on the weekly chart is this congestion area here, which coincides with the 21 exponential period moving average of about $20.46. $20.46 in the UNG. So you closed around $17.92. I don't think it would be unusual to expect some strength up to tag this level. And then from there, you really have to see, is this gonna provide resistance and it's gonna roll back over, or is it gonna start chewing its way through these levels and you're gonna get a change in trend taking place? At this point in time, it looks as though, that level's a magnet and it's gonna test that level. I don't really want to try and really prognosticate above that, or really, I'm not, in the markets, we're not always trying to predict where things are going. You just want to note the path of least resistance, and you want to trade the probability. So to me, it looks like that's what it wants to do. And to me, this area looks like a magnet. Okay. So if we jump over now, to the daily chart and see what the daily chart looks like, you can see here on the daily chart that, first of all, I have certain rules for trading. One of those rules is that the 20 EMA is kind of my line in the sand based on my experience between long and short. So at this point in time here, you had the market come and test the 20 period moving average, and it closed right at the 20 period moving average, and then the next day it came up and it tested the so here's the 21 period. I think it was the 35 period. It came up and tested the 35 period moving average, and then it sold back down just below the 21 period moving average, and it held the 8 period exponential moving average. At that point in time, taking into consideration that I didn't really like the short side any longer, for the because of that technical divergence we talked about, and then looking at it closing right at the 21, and then popping right above the 21 period moving average, and then not really going any lower, than this candle here. I really was cautious on the short side. I didn't really like the short side any longer. You also had the MACD crossover here. Now it's just testing the 0 line on the MACD, but you can see this indicator looks like it's going to roll higher. The MACD looks like it's going to roll above the 0 line. You can also see some volume coming in here, which is a little bit higher than usual, right? On the obviously on the buy side, you've got blue Hakanashis, and you're now finding support. You've got the 8 crossing over the 21 period moving average, right, which is a buy signal in itself, or at least a reversal signal. And you can see that the price action is coming down and it's holding support at the 8 and the 21, and it's pushing higher. Okay, at that point in time, I definitely don't want to be short this market anymore. In order for me to want to get short this market from a daily perspective, I would probably want to see a couple of things come into play. The first thing I'd want to see come into play is I'd want to see, well, not necessarily in this order, but I definitely would want to see the price come back down and close, okay, below or less than the 21 exponential moving average. That's the first thing I'd want to see, because the 21 EMA is my line in the sand between long and short. Okay, that's my line in the sand between long and short. So I'd want to see that happen. I'd want to see the Hakanashis turn red. Okay, I'd want to see red Hakanashis, a rotation from blue to red. And then I'd want to see the MACD also cross lower. I wouldn't want to see this turn blue. I'd want to see this go back to red and start picking up momentum to the downside. So at this point in time, I wouldn't want to be short the natural gas or the UNG. I think we pegged levels around. You can see these congestion levels on the weekly chart. It was $20. What did we say? $20.49 on the weekly chart, and you can see this congestion zone on the daily chart, which it probably is going to come up and tag somewhere around this level. And then from that point, then you want to see what the market is going to do. Is it going to find resistance there and pull back, or is it going to do one of these and push through? We don't really know, but I think those are the levels that are in play at this point in time, and those are the scenarios in play. Okay, I'm going to take a very quick look at the grains. I mean, quick for me. This part two, or this video, based on not looking at the stock indexes, but starting off with the currencies and the metals, etc., is already at 47 minutes, and the other video was at an hour. So it's pretty obvious I can't do anything in a short time frame in terms of analyzing this stuff, and I'm okay with that. And if it helps some of the members, and maybe looking at the markets in different ways, then we've achieved our goals. So that said, I can't really be apologetic. I think it's helpful, and if it's not, I mean, you can always turn it off. Okay, so that said, let's take a look at corn. Corn is just a weekly mess. You really need direction out of this Darvis box. You've got a Darvis squeeze situation in play. You've got a potential breakout situation on the weekly chart. I don't know which way it's going to go, but I would be looking for direction outside of this Darvis box. You've got a huge range in here. Okay, so if we take a look then at the soybeans, the soybeans went higher than I was expecting, but they finally did hit that resistance. And I think in the other videos what I was saying is I didn't really like, at this point, I thought soybeans would find resistance at this point or this point. Okay, so this is where I wasn't really interested in soybeans on the long side when it got to this resistance anymore. Then what happened was we came all the way up to this resistance. We broke that resistance, and then we kind of, this entire zone here we've been selling off from there. Okay, and we just broke the 8-period exponential moving average. So I don't think it would be unusual at this point in time with this kind of a market to come down and test the 21 exponential moving average, which is around 1354. So that would be a substantial move, but I think it is. I think it's possible. Do I think it's in the cards? Yeah, personally, I do think it's in the cards. I doubt that it's really going to hold. Even if it comes back up and does one of these, I still think it's probably going to tag this level at some point in the near future, within the next few weeks, because I think that this is really it's really overdone, and you just really haven't had a pullback for a long time. So if you look at the daily chart now, it looks like it's putting in a lower high, although it's not a clean lower high, right? And it's breaking this Darvis box. You've got red Hakanashis. This is rolled over. So if you get enough closes below the 21 period exponential moving average, I think that opens up the door. You break some of these support levels. That opens up the door on the weekly chart then to come down and test this level. And I think that's what's going to happen. I could be wrong, but I think that is what is going to happen. Now, if you look at this, this was a massive up move. I didn't really want to be long into this resistance. I thought, okay, once you hit that resistance, that's it. There's no reason to really be long that market anymore. I wouldn't be shorted either, but I was expecting a pullback. And you can see markets, when they have these awesome trends, look at how much further they can go before that resistance kind of takes hold. That's a substantial move in the soybeans higher. Now, if you were trading this to the long side and you said, okay, that's it, I don't want to be long anymore over that level, there's nothing wrong with that. You missed that last part of the move and now it's coming off. So it's impossible to catch tops and bottoms, but you can see reasonably where resistance levels are. And if you're on the long side of that, you might not catch, this entire move, but you can say reasonably, okay, you know what? That to me is the obvious resistance. That to me is the obvious resistance. A lot of people get tricked into the market thinking, oh, it broke the resistance and now it's going higher, and that happens often. I've been caught off guard a number of times with that and saying, well, I thought the resistance was there, but it looks like it's going higher. Maybe we should get on the long side again, or get on the long side, after that point. And then it worked for a bit, and then ultimately what you think should have happened in the first place ends up coming into play. So, just to kind of think about this going forward in the future, if you identify a major resistance level, it doesn't mean you have to get long above that until it really gives you a good reason to. So this was a good move. You had obvious resistance there. This is not surprising. Okay? That's not surprising. I found this blow off, which is not uncommon either, but I found this move above that the initial resistance more surprising than I find this move here. Okay? So to me, this was more surprising here than this is here. Okay? So I'm really expecting a little bit more of a pullback in the grains. That's what I'm expecting. Would I buy this pullback area? I don't know. I'd really have to see what it looks like at that point in time to see if it makes sense, to kind of look at this as a potential support area with a continuation higher. The other grains are, like the corn, and the corn doesn't really look like it's confirming at all. So the soybeans, the soybeans had its own little party without the. Sorry, I just paused the video there. I'm not sure where I left off. So what I was saying is the soybeans had its own little party without the corn in it, and now it looks like it's ready to kind of come back down to earth. The corn isn't really following. I'll just switch back to the corn there. It never really followed that move in the soybeans. It just kind of went sideways in its weekly and daily range. So there was no cross confirmation there. And then if we take a look at the wheat fired. Let me just see here. The wheat looks like it fired a short signals across the board on the daily and the weekly recently. So if we look at, let's start with the weekly chart. Actually, let's start with the daily chart. Let's expand out the daily chart and see. Originally in the video a few weeks ago, this is what I thought was going to happen, and I thought the soybeans, that would denote a pullback in the soybeans, and you can see that the soybeans actually went even higher, and it took a couple of weeks for what I thought was originally going to happen to happen. So now I'm not surprised at this move, because this is what initially I thought would happen. But from a timing perspective, my timing was off by a week or so. So this short signal here, I'm not surprised. I think that we'll probably get some downside here, because everything looks like it's in alignment for the short side. And you have potential targets in the wheat of, let's see, what targets are we looking at? 576. Okay, in the wheat you've got a target of 576.25. We're at 597, so you've got 20 to 21 potential full points of downside. Now, I personally don't trade wheat. I think wheat is a very thin, volatile market. I sure as heck wouldn't trade it. But this is kind of it's kind of telling, right? It's kind of telling of maybe some potential moves setting up here in the in some of the other markets if they're all going to kind of come into alignment. Now, on the weekly chart, you've got a short signal that has a target of 569. So you've got one target of 569. You have another target of, geez, I already forgot. You have another target of what did we say here? 568.5 on the daily chart. Oh, that's not right. Sorry, my bad. 576 and 569. So those are close enough where if you were to, let's say, look at that as a target, this would be your intermediate target, 576. Ultimate target would be, potentially 569. The key point isn't necessarily the level to me. This is the easier target. This one's a little bit, higher. But the key thing to me is that you have alignment or confluence between your daily and your weekly chart. So to me, that is more important than, let's say, just a daily signal. You've got, your daily is in alignment with what your weekly chart is telling you. So I would give that kind of decision more weight than I would give to just, let's say, one chart or the other, giving you a signal. When you see, multiple time frames come into alignment like that, I think you have to give them more relevance. You have to give them more weight. So that's all I have for this week. Just a heads up: the meetup for this month will not take place on the last Sunday of the month. It will take place a week later on. Let's see, I believe it is. So the last Sunday is the 27th. So we won't be having the meetup on the 27th. We'll be having the meetup the week after on the 3rd. And then we'll get back to our normal schedule because I'll be traveling. I'll be traveling this week, and I'll be getting back to 26. So I won't really be either in the frame of mind, nor will I be ready for the meetup on Sunday because of my travel schedule. So we'll pick up on the 3rd of May, technical analysis part 3. And we've had some good groups out at the last couple of meetings, and we hope to see you out at technical analysis part 3. We look forward to seeing you out there and discussing and learning some new concepts. We've the last meeting, I think there were about 12 people there, so it was a pretty good showing, and a good group of people asking a lot of good questions and a lot of good concepts discussed. So we'll look forward to seeing you there on the 3rd if you can make it. I'll be announcing in next week's video, which I'll probably have to do on Friday because I'm leaving on Saturday. Let's see, we're the 12th. Yeah, I'll be leaving on the 19th. So I'll be updating a video on probably on the close of the 18th and posting that. And just I'll be announcing as well the change of the meetup schedule as well. Now the meetup has been posted, so for those that are signed up for it, they will already have that information. They'll already get it, so no worries there. So have a great rest of weekend. It looks like it's going to be a beautiful weekend. Can't wait to get out there with my Boston Terriers and get a little bit of sunshine. And don't forget it's Mother's Day weekend. So give your mothers the proper respect they deserve, and hope you have a great Mother's Day weekend. If you're a mother yourself, treat your wives to dinner or something, and look forward to seeing you at the next meetup, at the next video. Feel free to drop me an email if you have any questions about the analysis or some of the things that I've discussed. Feel free to post in any of the forums.